Hi, JJ here again with The Art of Value. Welcome. Well, today I'm going to talk about Jeremy Grantham's recent interview with TIP. He gave a long interview and I'm going to summarize it here today and comment on what he said. He's talking about the super bubble again. I've made some previous videos about Jeremy Grantham's view on the bubble that's happening and now deflating. He calls it a super bubble and he explains why. And now he's talking about what stage we're at in that super bubble, how it's deflating. And we'll end on a bit of a positive note about where he says the best place to be, what he thinks where he is in the next decade, even though there's bad things coming, some bad surprises and a huge bubble deflating. So let's get into it.
I was reminded of the old aphorism that the Fed keeps on tightening until something breaks. And in a situation like this, and it reminded me of a conclusion that I had come to on the study of the great bubbles, the handful, the 5 or 6, including Japan in the last 100 years, because it seems to be the same. When you come down from a high, the ultimate sugar high of a super bubble, almost infinite optimism, a belief that good things will go on forever, that record profit margins, et cetera, et cetera. And the bubbles always form at the end of a long, heroic economy and everything in the garden is perfect. And it always has taken cooperation on the part of the Fed and the administration. So everything is perfect. And then when something pricks that confidence and it begins to leak out, there's a long way down to go from the peak of optimism to at least mild panic, if not severe panic. It's a long drop.
He talks about how there was euphoria in the market and it's a long way to drop. He goes on to say it's going to take a long time to deflate, but we're kind of in the middle of it. He details that further on what stage we're at, but he talks about the sugar high that happened with Euphoria, and we did start to see that in December 2020, early 2021 with the emerging tech stocks starting to fall, ARK, and it's kind of been down ever since, been going all the way down. So that's where he said it starts. But he generally talks about this euphoric high and it's going to take a long time to work its way out. So he's saying it's not finished yet. It's a long way to fall.
And at the top, people have always, in their confidence, have always expanded their debt levels. So they're always at or near the all-time peak in 1929 or 2000, the housing bubble and so on, and in Japan in 89. And as they were this time you had record levels of debt to GDP all over the world, but certainly including the US. And so as things unravel, of course, the combination of declining confidence and peak debt is a very bad one. My question really is, does it take the Fed or would it find the weak spot anyway, sooner or later? And maybe the Fed raising rates accelerates the breaking point. And I think of it as like water behind a dam. You're never going to be able to predict which brick goes first. In fact, you should expect the unexpected. By its very nature, it's a complicated financial system, a complicated economic system, and you build up the pressure and you build up the pressure as your confidence comes down and the debt begins to hurt, and particularly if the Fed is raising rates, and then something blows. And each time it seemed to be unexpected.
So here he starts to talk about some of the nasty surprises that could happen with this combination of falling confidence from that high, that peak optimism, and those record debt levels, and the Fed now raising rates at a very fast pace. So it's like, he says it's like a dam breaking, and so something's going to break, something more is going to break. It could be argued that things have broken. He talks about the Silicon Valley Bank happening and surprises like that. He said there could be more to come. If you're getting value out of this episode so far, please remember to hit like on YouTube or Rumble to help spread it to more people and to give me that little dopamine hit. Thanks.
Who imagined Bear Stearns would go, hey, the bear, as we used to call them, they were the guys that always inflicted the nasty paper on other people. And when the music stopped, they always had one of the jets. So when Bear Stearns went in 2007, it was a major surprise. And Silicon Valley, until you think about it and look at the balance sheet, it did appear to strike the world as a complete surprise. And maybe that is my point from 60,000 feet, is that is the nature of the beast. You should expect that the first thing that goes will, generally speaking, be a surprise. And then how it cascades is virtually unknowable.
So here he's comparing the surprise of Bear Stearns going under back at the beginning of the financial crisis, the global financial crisis, with Silicon Valley Bank, how that was a surprise. People weren't paying attention to it, and it was at the heart of Silicon Valley. So he says there were nasty surprises, and that was one surprise that's happened. People thought maybe that was the bottom of the market, and then bam, that happened and turned into a bit of a bank panic. So it went from euphoria in the tech sector in particular to a panic, a mild or severe panic, really, that was a bank run. It seemed to come out of the blue if you weren't paying attention to what was happening at the bank and how many people were.
But let it be said, after the handful of the great bubbles, there has always been a recession. If people behave well, the leaders are sensible, it's a mild recession. 2000 was about as mild as it comes. If they behave very badly and get unlucky, like 1929, you get a depression. Just concentrate on these few. They always have a recession. And when they want to take their time, they really take their time. Most of the decline in these great bear markets only happens after the first interest rate cut. So you tell me when the first interest rate cut is, and I will tell you when the second half of the pain is going to start. And it would be unlikely from a historical point of view that this was not run, this financial and stock market event would not run deep into next year. And that's what it looks like. It's not hurrying.
What he seems to be saying there is he sees a pretty harsh recession coming, a severe recession lasting quite a long time. Unlike after 2000, when the tech bubble, the dot-com bubble burst, it was a fairly mild recession. And of course, that led into years later, people putting money into the housing market and policies geared towards helping that. So it sort of switched, and then that ended up in a bubble too. But he sees it's recessionary times coming.
We had a very obvious first phase of the bubble. We pricked the confidence. It's easy. All you have to do is shake that complete and absolute euphoria. We did that. It popped nicely. Then you have a classic bear market rally. And we knew from the beginning, didn't we, that we would have more buy the dip this time than almost ever before because of the $1 trillion plus lurking around in the piggy bank from COVID stimulus and from the behavior of the meme stocks. We knew this was not going to melt away too quickly. And so we had the spectacular rally, and we may very well have more. And then you get into the third phase, and that is the fundamentals. And that's the difficult one. How long and how painful will the actual reality, the adjustment phase be? How badly will the economy slow down? How badly will profit margins shrink? Let me point out the most genteel one was 2000. We had a very mild recession. We've never had anything like a soft landing, but that was the closest. That was the least hard landing. And what happened? NASDAQ went down 82%. S&P went down 50%. Real estate was cheap. It was not involved. The bond market was cheap. It was not involved. Everything that was favorable could be favorable. And still it droned on for 3 years. And the NASDAQ went down 82%. That is what I'm interested in. Profit margins got hammered and the growth rate slowed down moderately. In the housing bubble, the GDP slowed down even more. Profits basically disappeared completely. 1929, of course, was even worse. So we're going to have an unknowable bad time. It will depend on how effective the administration is and so on. But the truth is, we come into this with very high profit margins. We come into it with a form of capitalism that was raising prices for the first time ahead of the workers, so that in unexpected inflation, very quickly profit margins went up and real wages went down. This is not what happened in the 70s, I can assure you. Profit margins went down and real wages went up. So we have a long-winded recessionary period coming any minute.
Okay, so here he talks about the phases of the super bubble working their way through, starting with that euphoria in emerging tech stocks. See, that was easy to prick after the COVID stimulus, huge amount of stimulus, but that was only the first phase, and that hit stocks. Some tech stocks down 50, 60, 70, 80, 90% in some cases, and they haven't come back. Some have. He talks about the bear market rally after that. We've had several bear market rallies really, only to be disappointed and to go down more. So he says that these long bubbles that take a long time to unwind, there's bear market rallies, and there's evidence for that historically. Bear market rallies can be 50% or more and then go down lower than the lows. And he obviously sees that happening. Will he be correct? We don't know. But he's saying it's going to hit fundamentals next. And this is why the next earnings season, the next reporting from companies, will they be doing well, or are fundamentals starting to be hit and we see a further slide in the share market? As he said, it's taking its time. It's working its way through. As he said, a recession to come, a longer recession, and obviously the share market slipping. Will he be correct, or have we already seen the bottom of the share market? Remains to be seen.
And into that period, we have much accelerated climate damage, probably knocked off 0.5% of global GDP, probably for the first year, a measurably large amount. Floods, fires, interrupting agriculture, flooding when you're meant to be planting and when you're reaping and so on, too hot for certain crops, chronic droughts hurting other crops, just a drag on growth, particularly in the developing world, but also a push on prices. It is inflationary. Then we have resource shortages. Part of the problem with no capex for the last 20 years is we don't have wonderful mines itching to come on the market as we had in 2011, 2012, when the last peak occurred. Most of the big miners had their last desperate giant new mines to bring on, which they did all together, like the good old days. And this time, there's no capex. There are no great mines waiting. We are simply on a flight path if we mean to green the global economy. We don't have anything like the amount of copper, lithium, cobalt, and nickel that we will need to get the job done.
So carrying on with the pessimism, but leading to optimism in the end, he talks about the climate damage that is happening leading into this recession, and that will continue and it will be a drag on global growth. And he talks about mining in the environmental sense, saying there's a resource shortage in terms of the, say, the battery metals needed, the lithium, the cobalt, which there is a question mark over how cobalt is mined, and other battery metals that are needed to have this green economy, the growth. He does see that as the best area. It's his particular area of interest, and he says half of his money in investments like that. So he talks about venture capital, how that's the way forward as we come out of the recessionary period. It's the only thing that's positive. It's the only way forward that he sees it. He does talk about that next.
So one of the jobs of a venture capitalist now should be looking at where the bottlenecks and problems will be, reaching forward and trying to do something about it. So lithium ion batteries can be replaced by sodium ion, can be improved by using half the lithium or half the resources. And they will be. But there simply is not enough lithium to do the job the old-fashioned way, typical of last year. We have to keep changing everything. And this is a fairly relentless pressure on prices. So research companies and early stage VC are right at the point of maximum vulnerability to a loss of confidence. That's the short-term story. And it may be a year or two of substantial difficulty. But in the long run, it's the only place to be. You're doing something worthwhile. You're generating new ideas. You're generating productivity gains. You're encouraging the economy in a world where economic growth has been slowing pretty steadily, and you're doing your best to counter it. And I think it will be in green VC. Of course, you have the backing of the entire world's governments all getting behind it now, IRA being a huge example, many multi-billions, but it's happening everywhere. And so it's like an unfair tailwind blowing you along. I'm very happy to have half my money there. Notwithstanding the next 2 difficult years, it's a hell of a place to be in the long run. I like to say it's the only case of potentially having your cake and eat it that I have ever come across, where it is exactly what we should do for the long-term well-being of the climate. And it's a candidate for making the most money of any sliver of investment in the entire capitalist system, that is pretty cool. And I certainly hope I'm right.
So he ends on a very positive note there, talking about early stage VC, which he's invested in. He says half of his money in greening the economy. So as not for 2 years, he said it's very vulnerable in the short term, these types of ventures. And we saw that with Silicon Valley Bank. This is where these types of companies, these types of entrepreneurs and VCs had their money in the bank. So there's shaky times ahead for the next couple of years, he said, and the recession that he sees. But coming out of that, he sees the green technology, green area, clean tech, if you like, clean technology. That's where he's putting his money for the next growth period, saying it's the only way to growth. And of course, we can talk about AI as well. That's another area that I can think of, which is already the most attention on right now. But he's looking 2 years ahead. He's got a lot of money in the green tech area, and he says there's a tailwind behind it, all governments behind it, which is correct. Is that going to be the next candidate for the growth period as we come out of the recessionary period that he sees ahead? So what do you think of what Jeremy Grantham said? Let me know in the comments. Is he correct about this super bubble unwinding? It'll take him a couple of years more, and then after that with some bright areas, starting with venture capital into green tech, into greening the world's economy with a big tailwind behind it. Do you think that he's going to be correct there, or what do you see as an alternative? Have we already seen the bottom and there's already a bull market? I made a previous video which I'll link to with Michael Burry, saying he said sell earlier on this year, and then he said I was wrong to sell. Is the bottom of the market already been and we're already in a new bull market? Jeremy Grantham doesn't think so. What do you think? Let me know. Well, if you got this far in the episode, please consider subscribing on YouTube, on Rumble, on Spotify, or your favorite podcast app. And thanks for watching or listening, and I'll see you next time.